Welcome to the Moving Markets podcast on Tuesday, the 3rd of February with me, Bernadette and Anderko. This morning, I will be talking to the Head of Product and Investment Content, Canziani, about the latest headlines in financial markets. And after that, I will be catching up with Carsten Menke, our Head of Next Generation Research, about the latest moves in precious metals markets. A difficult market to keep up with at the moment, so stay tuned for that. But let's crack on with the markets news. Good morning, Roman.
Good morning, Bernadette.
It was an interesting start to the week in Europe. We saw markets opening in a clear risk-off mood with that big commodity rout weighing on everything. But by the close, sentiment seemed to have flipped almost completely.
Yes, the turnaround was striking. The Stock 600 finished about 1% higher, which would have seemed unlikely if you only looked at the morning headlines. Financials were the stars of the day. Bank stocks had their strongest session since 2008. Healthcare also provided steady support.
Yeah, and all this while commodity-linked names were still struggling, so it's quite a contrast.
Exactly. You could almost see investors rotating in real time, moving out of the sectors hit hardest by the metals and oil slump and into defensives. Year to date, Europe is still outperforming the S&P 500, and that resilience is becoming a theme.
Yeah, and bonds also echoed the shifting sentiment. So yields initially fell on safe haven demand and then moved higher as the day unfolded.
Right. Early on, the flight to safety pushed yields down, especially with all the noise in commodities. But as US yields climbed on the expectation of a more hawkish Federal Reserve under its new leadership, Europe followed, but not to the same extent. Core sovereign yields in Europe ended slightly higher and peripheral spreads barely moved. It was a pretty orderly session by the close.
OK, speaking of cross-asset moves, currencies also had quite the dance yesterday, didn't they?
Yes, they did. Euro-US dollar traded like a barometer of Fed expectations again. With the dollar firmer, the euro ended a bit weaker, and commodity currencies, the Australian dollar and the Canadian dollar, struggled as metals and oil slid. It all fit neatly with the day's big narrative.
Yeah, and the narrative was really all about commodities, wasn't it? I mean, what a dramatic 2 days for precious metals.
Truly dramatic. Gold fell 4 to 5%, silver 5 to 7% yesterday, some of the steepest reversals in years. But much of it looked like forced selling in futures markets where margin calls tend to amplify moves. Oil was caught in a downdraft too. Brent dropped more than 5% as geopolitical worries had eased somewhat over the weekend. But the quick bounce this morning in gold and silver shows that positioning, not fundamentals, probably drove much of the metal sell-off. But Carsten will have more on that in just a minute.
OK, so let's shift to macro data. The Eurozone and the US painted very different pictures on manufacturing yesterday.
Yes, completely different. In the Eurozone, the PMI edged higher but still showed contraction. The encouraging part was the output grew slightly, but new orders fell for a third straight month, so demand is still soft. And there's a lot of country variation. Greece and France are expanding, while Germany, Italy and Spain remain in contraction.
Yeah, but the US data, on the other hand, surprised almost everyone.
Yes, the ISM index jumped back into expansion, rising to 52.6 points. New orders, backlogs, exports are all strong. It was the fastest pace since 2022. Some analysts link it to tax changes and the ongoing investment boom around artificial intelligence. But inflation signals remain sticky, with the prices paid component rising.
Yeah, and of course, across the Atlantic, US equities had a very solid session.
Yes, all major indices were higher. The Dow was up more than 500 points. The S&P 500 came close to a new record. Memory chip makers were the clear winners. SanDisk surged 15%. Western Digital jumped 8%. And Caterpillar and Walmart also lifted the Dow. Disney was the outlier, falling more than 7% despite strong results, with investors laser-focused on CEO succession.
And of course, tech darling Palantir delivered after the bell.
They did. Earnings and revenue topped expectations and the share price rose about 5% in extended trading. Management described a massive acceleration in growth tied to AI demand.
All right, well, why don't we wrap up with what's happened in Asia overnight and then the day ahead. Markets had a lively night, didn't they?
Yes, South Korea's Kospi surged more than 6%, with Samsung and SK Hynix rebounding sharply after heavy losses on Monday. India's Nifty 50 climbed too, helped by news of a US-India trade deal. And the Reserve Bank of Australia raised rates by 25 basis points to 3.85, citing persistent inflation. Today, markets will be watching US job openings, French inflation data, and a packed earnings calendar, including AMD, Merck, Pfizer, PayPal, and Electronic Arts. That's it from me.
Great. Many thanks for the news update this morning, Roman.
Thank you very much for having me, Bernadette.
Okay, let's dig into precious metals a bit deeper. Good morning to you, Carsten.
Hello, Bernadette. Good morning.
We've witnessed some of the most remarkable trading days in the history of the precious metals market as of late. Perhaps you could tell us what's happened.
Well, I think fundamentally not much, but as I've argued before, fundamentals were not in the driving seat of the precious metal markets anymore. The markets were all about flows as of late. It all started with the news of the nomination of Kevin Walsh as the next chairman of the US Federal Reserve on Friday, which then turned into a nightmare for the precious metals. Prices plummeted at an unprecedented pace, with silver down more than 25% for its largest one-day drop ever. Platinum and palladium lost more than 15%, while gold was down almost 10% on Friday alone. There was more selling on Monday, as Roman just said, but the market seemed to be regaining some lost ground today.
So why do you feel the markets reacted so strongly to Walsh's nomination?
Well, in our view, it was very clear that neither the nomination or the related rebound of the US dollar are in any way sufficient to explain this sell-off. That said, the same holds true for the US dollar's previous decline, which was nowhere near sufficient to explain the rally which we've seen. So we believe it was much more driven by the expected weakness, and not the realized weakness, but the expected weakness of the US dollar originating from fears of increasing political interference with the US Federal Reserve and a potential loss of trust in the US dollar as the world's reserve currency. These fears have clearly faded. Walsh is expected to fill the chairman's role more independently than some of the other candidates, alleviating concerns about increasing political interference with the central bank.
And the futures exchange in New York also hiked margins. So did that contribute to the sell-off?
Margins are the collateral which futures traders need to deposit with the exchange to enable daily settlement, i.e. to match gains with losses. And if prices swing wildly, as on Friday, the exchange needs to make sure that there is enough collateral, which is why it hiked margins. So as a trader, either you post more collateral or you close your position. Since the sell-off accelerated after the announcement, I think it's fair to assume that quite a few traders closed their positions. So yes, the margin hike added to the sell-off.
Okay, so getting back to the flows versus fundamentals topic, following the sell-off, how do you see the markets at the moment?
Well, the excessive volatility in the precious metal markets is a clear indication that flows are dominating fundamentals, i.e. speculative traders in the futures market are playing a much more important role than safe haven seekers in the physical markets. That said, physical demand is sound, as reported last week, for example, by the World Gold Council. Global gold demand reached a new record in the fourth quarter of last year, driven by strength in investment demand and also central bank buying. The two pillars of gold's record run thus remain in place, providing fundamental support to prices on elevated levels.
Okay, so what would you say are these price levels for gold?
The coming weeks, I think, will show what these levels are. From our point of view, it will take some time for the dust of this sell-off to settle. When prices went above $5,000 per ounce, I thought about a speculative premium of around 15 to 20%. And this suggests that today's fair price level should be around, I would say, $4,500 per ounce, which should be a very solid base to build up on.
And may I ask for the other metals?
I think by and large, the same also applies to silver, platinum, palladium. The dust needs to settle. That said, the speculative premium in those markets, I would say, was much, much bigger, so maybe even 40 to 50%. So here also the bottom or the fair price level searching process will take some time.
Carsten, very interesting. I'm sure we're going to be talking about this again very soon. But meanwhile, thank you for coming on the show today to update us.
Absolutely. Thanks very much for having me.
And that concludes today's show. Thank you to my guest today, and thank you all for listening. Please do tune in again tomorrow when Jan Bopp will be here as your host with more of our experts to discuss what's moving markets. So don't miss that. Meanwhile, good luck today and goodbye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.